here's the thing nobody wants you to understand. The richest people on the planet almost never sell anything. They don't cash out. They don't liquidate. They don't take profits the way your financial advisor tells you to. Instead, they walk into a room, slide a piece of paper across the table, and borrow against everything they own. And the government, the banks, the entire tax code, it is all designed to reward them for doing exactly that. This is not a loophole. This is the architecture. And you were never supposed to see the blueprints. Let me paint you a picture. Right now, as you listen to this, there is a man somewhere in the hills above Silicon Valley. He is worth, on paper, somewhere north of $15 billion. He has not sold a single share of his company's stock in over a decade. Not one. And yet, he just bought a $70 million ranch in Montana. He flew there on a jet that costs about $8,000 an hour to operate. He paid for his daughter's wedding last spring, a 3-day event on the coast of Italy that ran somewhere around $4 million. And his federal income tax last year? Practically nothing. Maybe less than what you paid. Maybe less than what your local school teacher paid. And if that sounds impossible, that is because you are still thinking like someone who trades time for money. You are still thinking like someone trapped inside a system that was built very carefully to keep you on the wrong side of the ledger. Now, before you call this a conspiracy theory, let me be clear. Everything I am about to describe is legal. Every bit of it. That is what makes it so devastating. Because the tax code in this country was not written by accident. It was not written by neutral scholars sitting in a library somewhere trying to figure out what is fair. It was written by lobbyists, by attorneys who bill at $2,000 an hour, by people who represent the interests of the ultra-wealthy. And the single greatest gift those lobbyists ever delivered was this: a tax system that punishes you for earning money but rewards you for owing money. Read that again. The system punishes income. It rewards debt. And once you understand that, the entire game changes. Let us start at the beginning. Let us start with the trap. Because there is a trap, and most people are standing right in the middle of it without even knowing the walls are closing in. The trap is simple. You work, you earn, you get paid. And the moment that paycheck hits your account, the government reaches in and takes its cut. Federal income tax, state income tax, Social Security, Medicare. By the time you are done, depending on where you live, you might be keeping 60 cents out of every dollar, maybe less. And here is what they never teach you in school. That is the most expensive way to get money in the entire financial system. Earning it, actually working for it, that is the most heavily taxed activity in the United States. Now think about the guy in the hills. He does not earn a paycheck. He owns assets, shares in his company, real estate, art, private equity stakes, and those assets go up in value every year. Sometimes 5%, sometimes 30%. But here is the key. That increase in value, that is not taxed. Not yet. Not until he sells. The IRS calls it an unrealized gain. It is like a pot of gold that keeps getting bigger, and as long as you never open the lid, the taxman cannot touch it. He just sits there, getting richer on paper every single day, and nobody sends him a bill. Nobody. Meanwhile, you clocked in at 8 a.m. this morning, and Uncle Sam was already waiting for you at the door. So the question becomes, if this man never sells, how does he actually live? How does he buy the ranch? How does he fuel the jet? How does he pay for anything? And the answer is the most important financial concept that the average person has never heard of. He borrows. He takes out loans against his assets. He walks into a private bank, one of those banks you have never heard of, one that does not advertise on television, and he says, I have $15 billion in stock. Lend me $200 million. And the bank says, absolutely. At an interest rate so low it would make your mortgage broker cry. We are talking maybe 1%, maybe 2%, sometimes even less, because the collateral is so massive, the bank views it as essentially risk-free. And here is where the magic happens. Here is where the whole scheme comes together like a watch built by the devil himself. That loan, that $200 million, is not income, it is debt. And debt is not taxed. Let me say that again because it is the most important sentence in this entire documentary. Borrowed money is not taxable income. So this man just put $200 million in his pocket, tax-free. He will use it to buy property, to fund his lifestyle, to invest in new ventures. And he will never pay a dime in income tax on any of it. The interest on the loan, that is his only cost. And even that, in many cases, is tax deductible. Now, let us go back in time, because this did not start in Silicon Valley. This did not start with tech billionaires and crypto kings. This strategy is old, very old. And its roots are tangled up in some of the darkest chapters of American financial history. Go back to the 1920s, the roaring era. The stock market is boiling over. Everybody is getting rich, or at least everybody thinks they are. And the richest of the rich, the Rockefellers, the Morgans, the Mellons, they're not just buying stocks. They're borrowing against them. Margin loans, they called them back then. You put up your shares as collateral, and the bank gives you cash. It was elegant, it was efficient, and for a while, it worked beautifully. Andrew Mellon, who also happened to be the Secretary of the Treasury, the man literally in charge of tax policy, was one of the greatest practitioners of this art. He shaped the tax code to favor investment income over earned income, to favor holding over selling. And then, in 1929, the whole thing collapsed. The market crashed. The loans got called in. Men who were worth $50 million on a Monday were bankrupt by Friday. Some of them jumped from windows. And for a brief moment, the country woke up and said, maybe we should not let the rich play by a completely different set of rules. So the government stepped in. The New Deal. Franklin Roosevelt raised the top marginal tax rate to levels that would be unthinkable today. At one point, the top rate hit 94%. 94 cents out of every dollar at the highest bracket went straight to the government. And for a brief window, maybe 20 years, there was something approaching fairness in the system. The gap between the rich and everyone else actually shrank. The middle class grew. Factories hired. Homes were built. It was the closest America ever came to the dream it kept selling to the world. But the wealthy did not just sit there and accept it. They never do. They hired lawyers. They hired lobbyists. They funded think tanks. And slowly, quietly, over the course of decades, they began to rebuild the machine. By the 1950s, new financial instruments started to appear. Trusts with names that sounded like something out of a legal textbook. Grantor retained annuity trusts, charitable remainder trusts, family limited partnerships. Each one designed to do one thing, move wealth from one generation to the next without the government getting its hands on it. And at the center of all of it, the same old trick: never sell, always borrow. By the 1960s and 70s, the strategy had been refined into an art form. The oil barons of Texas were doing it. The real estate dynasties of New York were doing it. They would buy a building, let it appreciate, borrow against the equity, use the borrowed money to buy another building, let that one appreciate, and borrow again. It was like a perpetual motion machine, powered by debt and asset inflation, and the IRS, despite its enormous power, could barely touch it, because at no point in the cycle did anyone sell anything. At no point did anyone trigger a taxable event. The wealth just grew and grew, hidden behind layers of loans and legal structures, like a tumor that the X-ray could not see. Now, let us talk about how this works in the modern era, because the machine has only gotten more sophisticated. Today, the ultra-wealthy do not just borrow against stocks, they borrow against everything. Real estate, art collections, yachts, private jets, wine cellars. There are banks that will lend against a Picasso hanging on your wall. There are lenders who specialize in nothing but securities-backed lending, where your stock portfolio serves as the collateral for a revolving line of credit that you can draw on whenever you want, like a checking account attached to your net worth. The mechanics work like this. Say you own $500 million worth of stock in a publicly traded company. You go to a bank, Goldman Sachs, JP Morgan, Morgan Stanley, one of the big names, and you pledge that stock as collateral. The bank will typically lend you up to 50 or 60% of the value. So now you have $250, maybe $300 million in cash, tax-free, because it is a loan. You use that money for whatever you want. You buy a house. You buy a vineyard in Napa. You start a new company. You donate to a foundation with your name on it. And here is the beautiful part. The stock you pledged as collateral, you still own it. It is still going up in value. You are still collecting any dividends it pays out. You have not given up anything. You just unlocked the wealth trapped inside the asset without ever triggering a taxable event. And what happens when the loan comes due? Do you sell the stock to pay it back? Of course not. That would trigger capital gains tax. Instead, you do one of two things. Either you take out a new, larger loan to pay off the old one because your assets have grown in value and you can now borrow even more, or, and this is the darkest part of the whole scheme, you die. And when you die, something extraordinary happens, something called the stepped-up basis. Your heirs inherit your assets, but the IRS resets the cost basis to the current market value at the time of your death. All of those gains, decades of appreciation, billions of dollars in profit, they are wiped clean, erased, as if they never happened. Your heirs can then sell the stock, pay off the loans, and keep the rest. The tax that should have been owed on a lifetime of wealth accumulation simply vanishes. Think about that. Really sit with it. A billionaire can live an entire life of extraordinary luxury, funded entirely by borrowed money, never paying income tax, and then, at death, the tax bill disappears completely. That is not a loophole. That is a cathedral built to protect wealth. And the architect was the United States Congress. Now, there is a villain in this story, but it is not a person. It is a system. It is the fundamental asymmetry baked into the tax code. The system taxes labor. It taxes the sweat on your back. It taxes the hours you spend away from your family. but it does not tax wealth. It does not tax the silent, compounding growth of assets sitting in a brokerage account. And that asymmetry is not natural. It is not inevitable. It was designed. Every provision, every exemption, every clause was fought over by teams of lawyers representing the interests of people who already had more money than they could spend in 10 lifetimes. The banks are complicit, of course. They love this game. When a billionaire pledges $500 million in stock for a loan, the bank faces almost zero risk. If the stock drops, they simply ask for more collateral or sell enough shares to cover the loan. They cannot lose, and the interest payments, even at absurdly low rates, are pure profit. So, the banks have every incentive to keep this engine running. They market these products aggressively to the wealthy. They assign private wealth managers whose entire job is to help clients avoid ever having to sell an appreciating asset. These are not financial advisors in the way you think of them. They are tax architects. They are escape artists. And their canvas is the tax code itself. There is even a name for this strategy in the world of high finance. They call it buy, borrow, die. 3 words. That is the entire playbook. Buy assets, borrow against them. Die, and let your heirs collect the spoils without paying the bill. And it has been working flawlessly for generations. Now here is where we turn the camera around. Here is where we stop looking at the billionaires and start looking at us, because there is a lesson buried inside all of this. And the lesson is not that you should try to become a billionaire. The lesson is that the system you have been taught to follow, the earn, save, spend system, was designed to keep you running on a treadmill. You trade your time for money. The government takes 1/3 of it. You spend most of what is left on things that lose value the moment you buy them. Your car, your clothes, your electronics. And at the end of the month, if you are lucky, you save a little. You put it in a retirement account that you cannot touch until you are 60, and you are told this is the responsible way to live. This is the path to security. But the wealthy do not play that game. They play an entirely different game on an entirely different board. They accumulate assets, things that go up in value, businesses, real estate, equities, intellectual property, and they never, ever let go of them. They squeeze every drop of utility out of those assets through borrowing, and they pass them down to the next generation, who does the exact same thing. So what is the escape? What do you do if you are not born into wealth, if you do not have a trust fund or a family office? The escape is a shift in philosophy. It is not a get-rich-quick scheme. It is a complete rewiring of how you think about money. First, you stop thinking of money as something you earn and start thinking of it as something your assets produce. Every dollar you save should go toward buying something that appreciates or generates income. A rental property, an index fund, a small business. These are not luxuries. They are tools. They are the bricks you use to build a wall between yourself and the taxman. Second, you learn to use debt intelligently. Not consumer debt. Not credit cards at 20% interest. Strategic debt. The kind backed by assets. When your portfolio reaches a certain size, you can borrow against it at rates far lower than any credit card or personal loan. And that borrowed money, remember, is not taxed. This is the same mechanic the billionaires use, just at a smaller scale. Third, and this is the hardest part, you stop selling. Every time you sell an asset to fund your lifestyle, you trigger a taxable event. You give the government its cut, and you lose the compounding power of that asset forever. The wealthy understand this intuitively. They treat selling as a last resort, the financial equivalent of amputating a limb. You only do it if you absolutely must. Fourth, you think generationally. This is the piece that separates the truly wealthy from everyone else. They do not think in terms of their own lifetime. They think in terms of dynasties. Every financial decision is made with the understanding that the real payoff may not come for 30, 50, even 100 years. The trust you set up today protects your grandchildren. The property you buy this year funds your great-grandchildren's education. It is a long game, and most people cannot play it because they are too busy surviving the short game. Now, I am not going to sit here and tell you this is fair. It is not. The system is rigged, and it is rigged in favor of people who already have capital. That is the cold, uncomfortable truth at the heart of this entire story. The tax code rewards ownership and punishes labor. It rewards patience and punishes necessity. And if you are someone who lives paycheck to paycheck, none of this feels like freedom. It feels like a slap in the face. But here is the thing about knowing how the game is played. Once you see the board, once you understand the rules, you can start making moves. Small moves at first. Maybe you buy your first rental property. Maybe you open a brokerage account and start building a portfolio that you swear you will never sell. Maybe you set up a simple trust for your children. These are not billionaire strategies. They are the seeds of the same strategy, planted in different soil. The real secret, the one they bury deepest, is that the wealthy do not have a different kind of money. They have a different relationship with money. They do not see it as something to spend. They see it as something to deploy. They do not see assets as things to cash in. They see them as engines that never stop running. And the fuel for those engines is debt, cheap, tax-free, legally sanctioned debt. So the next time you hear someone say that a billionaire paid 0 in income tax, do not be shocked. Do not be outraged. Be curious. Ask yourself how, because the answer is not complicated. The answer is 3 words, and it has been hiding in plain sight for 100 years. Buy, borrow, die. That is the game. And now, for the first time, you can see the whole board. The question is, what are you going to do about it?